Ready to go? Yep. Hey, so I'll give a presentation about risk management and decentralized finance. This may be a topic that's a bit less sexy than what we had on the stage earlier today. But I feel that it's very important for both people allocating capital in DeFi, but also people building protocols and building liquidity pools to kind of get the point of view on the asset manager side and on the liquidity provider side. So what this presentation will be about is to kind of give an overview of how sophisticated LPs and sophisticated asset allocators look at the risk in DeFi. So brief background on myself and Dialectic. So Dialectic is a Swiss asset manager. We execute three main strategies. So we have an early stage venture capital fund that invests in DeFi and infrastructure and gaming and all sorts of companies in that space. And more importantly for this presentation, we do run two DeFi yielding vehicles, one being stablecoin denominated and the other one being ETH denominated. So we have been doing this for 3 years now, basically since DeFi summer started. And so we had a lot of time to refine the risk frameworks and to refine the way that we look at risk and that we measure risk and the way that we allocate liquidity across DeFi. I myself am the CTO and I'm portfolio advisor on the ETH-denominated yielding book. So I've built out a bunch of the software that we use to manage the risk, as well as provided some input to the investment team around the risk management framework and how we look at that. We also work quite closely with protocols and ecosystems to provide specific liquidity to key pairs. So many of the big ecosystems that are launching now, they require liquidity on stablecoin pairs or different ETH pairs. And they found it rather efficient to work with professional parties like us to provide liquidity in very specific pools on specific conditions. So why do we care about risk? I mean, most of you are aware that DeFi is a rather adversarial environment. Some people call it a large financialized PvP game. Because on the one side, we have the users who hold their assets and who want to get some yield on their assets, so they deploy it into liquidity pools. But then on the other side, we have a set of users that is highly adversarial and that is actively trying to exploit the protocols and steal the liquidity and basically wreak havoc in DeFi. And we even have like state-level actors such as Lazarus Group from North Korea, who was responsible for some of the largest hacks that we had in the space. And so it's very important to understand that anyone can access DeFi, anyone can play with DeFi, and anyone can try to exploit the different protocols and steal the liquidity. And this is why, for someone like us who has like large amounts of capital deployed across DeFi, having a very strict and coherent risk framework is the only way that you can really do yield farming at a large scale. So the meat of the presentation will be around the risk framework and all of the different categories of risk. And then I'll also have a couple of slides about risk mitigation that will kind of go through some ways to do this in a sustainable and safe way. So the way that we look at risk is that we break it down into 5 main categories. So we have the chain risks, which are all of the risks associated with the infrastructure layer. So this would be like the economic security in a proof-of-stake network. It could be things around like centralization of key nodes and things like sequencers. And here we mainly care about the consensus as well as the liveness. Because even like liveness, if a chain is down for a prolonged period of time, that may cause some problems for oracles and lending markets that don't have up-to-date price feeds. So that's everything that has to do with the infrastructure layer and the chain layer. After that, we need to look at the bridge risk. So anytime we are deploying assets that are not on the Ethereum mainnet, we need to bridge those assets to the chain that we are deploying on. And so we do have some exposure to the bridge that is issuing those assets. And if the bridge were to get hacked or drained, the bridged assets would depeg, their value would go to 0, and we would have a loss on that. Then going down the stack, we reach the smart contract risk level. This is actually probably the biggest risk in DeFi. Like historically speaking, if you look at the assets lost in DeFi due to exploits, a big part of that was smart contract exploits. And it's a very difficult thing to manage because smart contract systems can get quite complex. And as we'll see in a bit, there's a lot of dependencies and things to consider. So yeah, smart contract risk is a big one and a rather difficult one to assess and mitigate. But then even if the smart contracts are fully written correctly and it's all safe and sound, most of the protocol have some economic mechanisms that could get compromised. So in the case of lending markets, for example, we need to look at the collateral type, we need to look at the LTV, what the liquidation procedures are, and all things related to that. Then many protocols rely on oracles, so they need some external price feed to price the assets, and oracles can be manipulated. So all of those types of risks we bucket in the economic risk category. And then lastly, we have governance risk. Now this is important because most protocols are upgradable. And so when we do a due diligence on a protocol or an asset, we are basically looking at a snapshot in time. And if the protocol is upgradable, it could be upgraded, and that could introduce some vulnerabilities or some extra risks that the users are exposed to. So we need to analyze who can update the protocol, how the protocol can be upgraded, what's the time lock situation, and all things like that. So once we define the 5 risk categories, we need to understand that DeFi is highly composable. And when we look at a specific pool, so the example here is this $FRAXPP pool, which is a Curve pool, and the Curve LP token is staked in Convex. We don't just have exposure to a single protocol, but we actually have exposure to a bunch of underlying dependencies as well. And what we're trying to do, so the end goal here, is to basically get to a risk score for each one of the pools in DeFi that is coherent and that allows us to compare the risk of different pools. So in this specific example, we would have a chain risk on the Ethereum chain, which is basically very low. We don't have any bridge risk because all of the assets are native to Ethereum, so we're not exposed to any bridges. But then on the smart contract, economic, and governance side, we do have exposure on multiple levels to multiple protocols. So we have exposure to Convex, Curve, and then Dollar. The stablecoin is issued by Inverse Finance, which is its own protocol, which it's with its own set of smart contract, economic assumption, governance model, and so on. And the same for FRAXPP. So this is kind of one way to visualize it. And the way that we then get to a quantitative risk score for any specific pool is by basically compounding the risk of all of the dependencies. And for each one of the dependencies, we compound the risk of the individual categories. So in the previous slide here, we would have like a risk score for Convex, which is made up of the chain risk of Convex, the bridge risk of Convex, smart contract, economic, and governance risks. And so basically, if we know the risk score for the underlying dependencies, we can compute a risk score for the pool as a whole. And the above formula here assumes that all of the risks are weighted equally, which is not really the case. Usually something like a chain risk would be much lower weighted than smart contract risk, because as I said, it's much more common for funds to be lost in DeFi because of smart contract exploits rather than a chain going down or some issues with the chain. So basically, a way that we can represent DeFi pools is with a dependency graph. So here on the left, we have the example of the $FRAXPP pool from before. And we see that there is a node, which is the pool. And then this pool lives on a chain that is Ethereum. The pool belongs to a protocol that is Convex. Convex operates on Curve. And then the assets in the pool are FRAXPP, which is basically just USDC and Frax. And USDC is issued by Circle, and Frax is issued by Frax, and so on. So we can see that it gets a bit more complex than what you would think at first glance. And then here on the right, we have an even more extreme example. And let me just close this. OK, so here on the right, we have a more extreme example, which would be the EUSD HYUSD pool on Curve. So this LP token is staked on StakeDAO. So again, we have exposure to Curve, we have exposure to StakeDAO. But then EUSD and HYUSD are both tokens issued by Reserve Protocol. And HYUSD is actually collateralized by a bunch of yield-bearing stablecoins. So HYUSD is collateralized by Morpho USDT, so we have exposure to Morpho. It also contains some exposure to Flux Finance through FUSD. It has exposure to SDAI, so Maker. And as you can see, if any one of the underlying dependencies would be compromised, then that would have a chain reaction that causes the HYUSD token to depeg, which would cause the Curve pool to get unbalanced, and that could ultimately result in a loss on the final position in StakeDAO. So I think this is a very nice and elegant way to represent DeFi composability. And it makes it very clear and intuitive what all of the dependencies are. And it's just very cool to see like DeFi pools represented this way. OK, so now that we rather should have a good understanding about the different risk categories and how they compound and all of the dependencies that matter, we can start to look a bit about how to mitigate the risks. And so rather obviously, the first big step that you have to do is to do a full due diligence on everything that you have exposure to. So in this chart down here, we would need to do a full due diligence on each one of the underlying protocols, the underlying assets, to get to that risk score that I showed before. And so the way that this due diligence also needs to be done is that it needs to be very coherent, because if we apply different methodologies to score the risk on the different pools, and we have human bias and things like that, then we can't actually use the risk score to compare the different pools one to the other. So the due diligence needs to be very coherent and very deep and analyze all of the things that are relevant. But then even when we did the due diligence and we know roughly what the risk exposure of a specific pool is, we need to keep monitoring it in real time, because as I mentioned before, most protocols are upgradable. And so if someone does an upgrade to a protocol, that may drastically change the risk profile of this. And a small point of on this is that when a protocol gets updated, we need to do a full reassessment of the risk on the protocol. So if there is no time lock and the update just gets shipped to the live smart contracts, then we are usually forced to withdraw liquidity from the pool, do a full due diligence on the changes, and then redeploy if it's safe. This is usually a problem for the protocols that we work with and that we provide liquidity to, because when you are doing a big protocol upgrade, then it's usually because you're shipping a new feature, new protocol version. So a bunch of liquidity leaving the protocol after you do a update is usually not ideal. So here, for the people building protocols, please use time locks. Please use time locks that are more than a couple of minutes. And be very open and transparent about upgrading the smart contract so that all of the LPs have enough time to assess the changes and get comfortable with them and don't have to react quickly and withdraw liquidity. So then, once we did due diligence and we have our monitoring up to date, we can do some diversification. Because ultimately, diversification is the best way to manage risk. That's how risk is managed in TradFi most of the time. And we can actually use a lot of the TradFi methodologies and portfolio construction methods to build well-diversified portfolios. And to actually properly diversify a portfolio, as said, we need to have sound risk scores. So we need to understand what the risk is on all of the different opportunities. And these risk scores need to be coherent and comparable one to the other. But we also need to understand what the correlations are between the different risks. So if we deploy into 50 different pools on Convex, on the surface, it may look diversified because we are in 50 different pools. But then if they all depend on the same smart contracts, if they all rely on Curve, then it's not actually diversified. And so once you have like a full risk overview of all of the opportunities and you have a return overview of all of the opportunities, you can use things like efficient frontiers to build optimal risk-adjusted portfolios. So you can say, this is the level of risk that I'm willing to take. What's the optimal portfolio that gives me the highest return given that amount of risk? And to properly diversify, you need to basically see as many pools as possible. So we build a bunch of software that tracks a lot of DeFi pools. So we have close to 15,000 pools that we're tracking. And those are spread across 1,400 different protocols in DeFi. That's all EVM chains. And so we can have a very broad overview of all of the pools that exist in DeFi, and we can score the risk for all of these pools with the methodology explained before. And then with such a big universe of opportunities, you can actually do some very good diversification. So you can really go broad and allocate funds in a very broad way, so that if any one of the specific protocols has an issue, it shouldn't cause a sizable loss at a portfolio level. And then the last thing that you can do to kind of mitigate risk is more of the real-time automation. So we use smart contract wallets. Most of the funds are deployed through smart contract wallets. And what this allows us to do is to basically react in real time to any changing conditions. So if, for example, a stablecoin was about to depeg, and we see that there is some threshold that gets passed, we can automatically withdraw the liquidity and like avoid getting rugged on some stablecoin depegging or something like that. And this also goes for smart contract exploits. There's different providers in the space that have real-time alerting on smart contract exploits, so you can also integrate that. And then you can just get out of the position, get your funds back to safety if something catastrophic is going on. So the conclusion here is for the LPs and for the people allocating capital in DeFi, it is a highly lucrative business. I mean, especially right now that the yields are coming back and the returns are very high, there is a lot of good returns to be made by allocating funds to DeFi, with the caveat that the risks needs to be managed. Because if you're getting 50% APR on a farm, but then you get drugged, you're still probably down a bunch. And for the people building protocols, as liquidity is getting more scarce and as the competition for liquidity increases, it's very important to understand how the LPs perceive your protocol from a risk perspective. Because it's usually not enough to just throw a bunch of incentives and liquidity rewards onto the pools. Because if the LPs think that the risk that they're taking by deploying capital in the pool is higher than what you're paying them, then you won't get any liquidity. So understanding a bit how the LPs look at the protocols and how risk is assessed, I think is very important, especially moving forward into an environment where liquidity is more scarce and more competitive. So thanks so much for listening. This was it from my side. I'll be down there if anyone has questions.